Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Malibu Boats, Inc. quarterly report. Malibu Boats, Inc. offers a diverse range of recreational powerboats that cater to various needs and preferences. The company's product portfolio includes performance sport boats, sterndrive, and outboard boats under several brands such as Malibu, Axis, Pursuit, Maverick, Cobia, Pathfinder, Hughes, and Cobalt. The company operates through three distinct segments: Malibu, saltwater fishing, and Cobalt. The Malibu segment focuses on performance sport boats, while the saltwater fishing segment provides products for fishing enthusiasts. The Cobalt segment offers luxury powerboats designed for recreational boating and entertainment. Malibu Boats sells its products through a network of independent dealers, ensuring that customers can find their desired boat from authorized retailers. With over 3 decades of experience in designing, engineering, manufacturing, marketing, and selling recreational powerboats, Malibu Boats has established itself as a leading player in the industry. Malibu Boats, Inc. stock price drop overview. In recent years, Malibu Boats, Inc.'s stock price has experienced a significant decline. One major factor contributing to this drop is the company's struggles with supply chain disruptions and inventory management issues. The COVID-19 pandemic had a profound impact on global supply chains, leading to delays and shortages of essential materials. Additionally, the rise of electric boats and alternative watercraft has posed a threat to Malibu Boats' traditional business model. As consumers increasingly prioritize sustainability and environmental concerns, the demand for gas-guzzling powerboats has decreased. This shift in consumer preferences has put pressure on Malibu Boats to adapt and innovate its product offerings. Furthermore, the company's reliance on a few key suppliers has made it vulnerable to price fluctuations and disruptions in the market. The inability to secure stable and reliable supply chains has resulted in increased costs and reduced profitability for Malibu Boats. Lastly, the company's failure to effectively manage its inventory levels has led to overstocking and write-downs of unsold products. This has not only resulted in significant financial losses, but also impacted the company's ability to respond quickly to changing market conditions. Overall, a combination of supply chain disruptions, shifting consumer preferences, supplier vulnerabilities, and poor inventory management have all contributed to Malibu Boats' declining stock price over the past year. Malibu Boats, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Malibu Boats, Inc. trades at a higher price-to-earnings ratio of 41 times, and a higher price-to-book ratio of 1.15 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the company's performance across various segments. Revenue growth is primarily driven by the Malibu segment, which saw a significant increase in net sales due to increased unit volumes and favorable market conditions. The Cobalt segment also contributed to revenue growth, albeit at a slower pace, thanks to favorable model mix and inflation-driven price increases. On the other hand, the saltwater fishing segment experienced a decline in revenue due to lower wholesale shipments driven by reduced retail activity. The Cobalt segment's units also declined, contributing to its overall revenue decline. However, it is worth noting that the Cobalt segment's revenue decline was partially offset by favorable model mix and inflation-driven price increases. Overall, the company's revenue growth or decline can be attributed to a combination of factors, including changes in unit volumes, market conditions, and product mix. The Malibu segment's strong performance and the Cobalt segment's mixed results highlight the importance of segment-level analysis in understanding the company's overall revenue trends. The net income of the company experienced a significant decline over the past period. Initially, it dropped by $12.3 million, representing a decrease of 32.9%, resulting in a net income of $25.1 million. This trend continued with another decrease of $12.6 million, amounting to a 19.2% drop, bringing the net income down to $53.1 million. Furthermore, there was a more modest decline of $1.5 million from $20 million to $19.2 million. The profit margins also underwent a notable change during this period. The gross margin saw a substantial decrease of 540 basis points. Additionally, it dropped by 380 basis points, reducing the gross margin percentage from 17.6% to 13.8%. These changes in net income and profit margins suggest that the company faced significant challenges in maintaining its financial performance over the past period. The company's financial performance indicates a consistent generation of positive operating cash flow. As per the latest figures on page 13, the net cash provided by operating activities has been steadily increasing over the years. In 2024, the company generated $20,005 in operating cash flow, and this figure rose to $19,182 in 2025. This trend suggests that the company is efficiently managing its operations and generating sufficient cash to meet its financial obligations. The positive operating cash flow is a testament to the company's ability to maintain a healthy financial position, which is essential for long-term sustainability and growth. The company's debt level and interest expenses have undergone significant changes. On the one hand, the total liabilities have increased by $1,692 from $214,745 to $216,437. Additionally, the revolving credit facility has seen a notable increase, with $20 million outstanding as of December 31, 2025, up from $0 in the previous period. However, this is a decrease from the $23 million borrowed under the same facility at the end of 2024. On the other hand, interest expenses have decreased significantly. For the 3 months ended December 31, 2025, interest expense was $324, down from $585 in the same period in 2024. This represents a decrease of 45.3%. Similarly, for the 6 months ended December 31, 2025, interest expense was $747, compared to $981 in the same period in 2024, resulting in a decrease of 24%. Overall, while debt levels have increased, interest expenses have decreased, indicating that the company is managing its debt more efficiently. Management is expressing caution about the company's outlook due to macroeconomic challenges such as inflation and high interest rates affecting the recreational powerboat industry. They anticipate dealers will further reduce inventories in fiscal 2026 due to high flooring costs and a soft retail environment. However, management remains optimistic about increasing market share through new product development, improved distribution, and innovative features. In the near term, they expect reduced consumer demand and dealer pressure, but plan to leverage cash generation to invest in the business. The company's financial position is strong, with sufficient cash on hand and operating cash flows to finance activities for at least 12 months. Management plans to continue investing in new models, capacity enhancements, and vertical integration initiatives, while maintaining a healthy balance sheet with available borrowing capacity of $328.2 million. The company has made significant investments in its shareholders through share buybacks. In a strategic move to boost shareholder value, the company repurchased 751,202 shares of Class A common stock under its 2025 stock repurchase program. This initiative demonstrates the company's commitment to returning value to its investors by reducing the number of outstanding shares and increasing earnings per share. The total cost of these share buybacks was $20.8 million in cash, a substantial investment that reflects the company's confidence in its future prospects. By buying back shares, the company is essentially providing a direct return on investment to its shareholders, which can have a positive impact on the stock price and overall market perception. This move also highlights the company's focus on shareholder value creation, as it seeks to maximize returns for its investors through various means, including share buybacks. As the company continues to execute its strategic plans, it is likely that we will see further initiatives aimed at enhancing shareholder value. Concerns about inventory buildup and potential supply chain disruptions have been raised in recent reports. Inventory levels are a cause for concern, with raw materials and work-in-progress inventories increasing while finished goods inventories decrease. This trend suggests that companies may be struggling to manage their stock levels effectively. Furthermore, there is also a risk of supply chain disruption due to external factors such as tariffs on material supplies. While not explicitly mentioned as a concern, monitoring the impact of these tariffs on supply chains is necessary to mitigate potential risks. Additionally, dealers' desire to hold less inventory and lower wholesale shipments due to reduced retail activity may also contribute to supply chain disruptions in the future. That concludes the financial summary for Malibu Boats, Inc. Feel free to comment below, and I will be happy to answer them when possible.